This section will discuss about derivatives contract. Financial futures. A futures contract is a standardized, exchange-tradable contract between two parties to trade a specified asset on a set date in the future at a specified price. Financial futures are based on an underlying financial instrument, rather than a physical commodity. Financial futures exist in four main categories that are bond futures, short interest rate futures, stock index futures, and currency futures. Next is futures contracts versus forward contracts. Like futures contracts, forwards are contracts to buy or sell an asset on an agreed basis in the future. The difference is that futures contracts are standardized contracts that can be traded in a recognized exchange. A forward contract is a non-standardized and privately negotiated contract between two parties to trade a specified asset on a set date in the future at a specified price. Whereas, a futures contract is a standardized, exchange-tradable contract between two parties to trade a specified asset on a set date in the future at a specified price. Next section is about option market. An option gives an investor the right, but not the obligation, to buy or sell a specified asset on a specified future date. There are four types of options for this syllabus. 1. Call option, where it gives the right, but not the obligation, to buy a specified asset on a set date in the future for a specified price. 2. Put option, where it gives the right, but not the obligation, to sell a specified asset on a set date in the future for a specified price. 3. European option, where it is an option that can be exercised only at expiry. And 4. American option, where it is an option that can be exercised on any date before its expiry. There are three uses of option. Options allow a company to protect itself against adverse movements in the financial environment while retaining the ability to profit from favorable movements. For example, a company that has borrowed at variable interest rates could purchase options to protect itself against increases in market interest rates. If rates fall, the company will only suffer the loss of the premium paid to purchase the options. Finally is the swap contracts. A swap is a contract between two parties under which they agree to exchange a series of payments according to a prearranged formula. The swap will be priced so that the present value of the cash flows is slightly negative for the investor and positive for the issuing organization. The difference represents the price that the investor is prepared to pay for the advantages brought by the swap on the one hand, and the issuer's expected profit margin on the other. Risk related to this contract are market risk and credit risk. Two types of swap you should learn in this syllabus that are interest rate swaps and currency swap. Interest rate swap is where one party agrees to pay to the other a regular series of fixed amounts for a certain term. In exchange, the second party agrees to pay a series of variable amounts based on the level of a short-term interest rate. Both sets of payments are in the same currency. Next is a currency swap. A currency swap is an agreement to exchange a fixed series of interest payments and a capital sum in one currency for a fixed series of interest payments and a capital sum in another. Last but not least, the uses of swap. Swap basically is used in company risk management to reduce risk by matching its assets and liabilities. Swap also can be used in reducing the cost of debt, where if one company has a comparative advantage in borrowing at a floating rate while another company has a comparative advantage in borrowing at a fixed rate, they can use an interest rate swap to reduce the total cost of financing and both benefit from a lower cost of debt.